From the president come dozens of pronouncements and policies.
It's a whirlwind. Number of issues and speed that is being thrust on us all at once.
But I think what we should also know, what we have just lived through in this first 90 plus days thus far, is him screwing up. It's him absolutely blowing it.
U.S. President Donald Trump marks 100 days in office on April 30th. From his on-off tariffs to
President Trump says during his second term, he runs the country and the world. That is from his latest interview out just minutes ago, marking his 100 days in office.
Over the next few minutes, I'm going to walk you through 8 specific companies that are particularly well positioned despite or even because of the current crazy market and the tariffs. I'll show you exactly what metrics matter right now, point out signals that most retail investors miss entirely, and give you actionable insights you can implement immediately. If you can hear the sirens outside, they're coming for me. But first, and way more important than these 8 stocks that you can obviously jump through, if you want to learn how I select these and how you can select stocks without having to rely on some guy on YouTube, then I'm going to actually teach you the same rules that the most successful investors out there have been using for 30, 40, even 50 years. I learned these rules from my mentors who were traders in Chicago and Wall Street and other investment banks and hedge funds. And it's very simple. It's really just 3 things. And once you know the rules, you will start buying more winners. And B, you will never lose a large amount of money on a stock again, ever. It's really avoidable. I didn't know it was avoidable till I learned these rules. So I give you these rules for free, but rather than making this video an extra 15 minutes long to explain the rules, I put them into a separate video, which you can watch at felixfriends.org/getfree. Link is down below. First in the description, it's felixfriends.org/getfree. I would do that rather than watching this video, because would you rather know how to fish or would you rather I give you one fish? I know the immediate sort of satisfaction is there, but ultimately you're going to go hungry again tomorrow. So go learn the rules, my friend. Now, as we approach at the 100-day mark of the current administration, the S&P 500 had, well, pretty tough time so far. The index was down about 6% through this Monday, which is pretty historically weak compared to pretty much any other presidency out there. Now, history gives us some much-needed perspective here. While a slower start typically means a more modest overall outcome over the presidency, the market is quite frequently recovered and delivered very nice positive returns over the full 4 years. Eisenhower and Reagan are good examples of exactly that. Now, the reality is, though, and I want to be really frank with you about that, near-term uncertainty remains, but historical precedent strongly suggests that this crazy start doesn't necessarily mean we're going to have a bad outcome in the medium or long term. Although having said that, I'm actually very bullish, moderately bullish for the short term, and I'm much more cautious about the medium and long term because there's a lot of unknowns there. We don't know the trade deals, we don't know the tax cuts, a lot of stuff is still that needs to be clarified. And it's with that in mind that I'm selecting companies here that have resilient business models, strong fundamentals, and very clear growth catalysts. So let me give you 8 stocks here. We're going to kick off with Warren Buffett's favorite, Coca-Cola. I know it's not a tech stock, but hear me out. What's compelling about them right now is their exceptional positioning amongst all this trade tension. They have brilliantly capitalized on their US-based production of soda concentrate, which effectively shields them from additional tariffs that are now hammering competitors. You see, Coca-Cola has a bottling model in every single market. They set up local bottlers or outsource it, and then all they do is they deliver the sweet sauce. But the sweet sauce is made in the United States, so tariffs don't really affect them. Pepsi, for example, well, they're facing a 10% tariff because of their Irish production setup, which isn't quite so great. So Coca-Cola is in a very sweet spot here. And the stock's up very significantly so far this year, which is pretty impressive given how weak the rest of the market's been. And it's a sort of company that just helps you sleep at night. Something that certainly Winston, my trusted golden retriever, who's done all the research here, by the way. This isn't financial advice. This is golden retriever advice. He certainly appreciates that kind of stuff. He snoozes very, very sweetly. So let's have a look at their scorecard. Cash flow is a C. Growth health is also a C. Price momentum, a B. Profit health is an A. That's what I like. Relative value is an F. So it tells you Coca-Cola isn't cheap, but its profit generation is exceptional. The financials reveal strong profitability, high gross margins, high net income margins, very reliable dividend payments. So if we look at the stock chart here, what do you see? Well, beginning of the year was, let me draw a little, that was the beginning of the year here, 2nd of January. And the stock's rallied very, very, very impressively since. So what am I looking at here? Well, what I'm most looking at, and I'm going to keep this as simple as possible for you guys today, is you see the yellow line. The yellow line, and it'll be the same yellow line on every chart I'll show you, is the 50-day moving average line. If you're above that, happy days. So what are we looking at? Well, we looked at a nice little rebound here of that. The previous low was here, and right now we're here. So what I'm seeing, hopefully, is a nice little bounce off that 50-day moving average. Like, again, we don't have to go quite as low. And that actually builds strength. And then you have one high, second high, third high, fourth high. Do you know what can you see what I'm talking about here? Each high is higher than the previous one. So this is a very, very nice bullish setup. We've seen decent volume as we keep going higher. A bit of pullback there in the last few days. I think it's just the normal ziggity-zaggity thing the market does. People were fleeing into Coca-Cola when they were really fearful. Now people are a little bit less fearful. They're moving away from it just a little bit here. And that's exactly the sort of moment where I might fill up my Coca-Cola holdings. I do own the stock, by the way. And I think it's just one of those things that you can't really go wrong with owning Coca-Cola, but you want to buy it in the right moments. Is this one of those right moments? I think it's pretty close. Yeah, I mean, whether you're a few dollars down or not doesn't really make a huge difference here. But I like how it's bounced off the COVID fear. I was going to say the Trump fear here, and it's rallied even stronger, closing really, really high. So to me, this is just one of those long-term winners. I'm holding it right now. I actually also own a couple of other Coca-Cola related stocks, Coca-Cola Mexico and Europe and so on. But for me, Coca-Cola is kind of the favorite out of all of those. Now, moving on to a more aggressive opportunity. Celcius Holding. Not that far removed from Coca-Cola in a sense, but they made a very aggressive acquisition of Alani Nu, and I'm probably mispronouncing that, $1 billion in retail sales, approximately 70% year-over-year growth, which is just extraordinary in the beverage space because you're taking on literally Coca-Cola, which is bonkers. And it's going to give Celcius a lot more market share in the energy drink segment and the sort of healthy energy drink segment. I mean, no, the two words don't go together. I don't drink this stuff, by the way. I probably have one Coca-Cola a year spread over the entire year, and I've never touched Celsius, nor will I ever do, probably. But that doesn't mean I can't make money out of the stock, right? So let's look at the scorecard. Headmaster says cash flow is a B, growth health is a B, price momentum is a B, profit health is a B, relative value is a D. Very consistent. Not quite as profitable as Coca-Cola, but they did just make that a big acquisition. They're expanding a lot more aggressively, and it's cheaper than Coca-Cola because it's got a D rather than an F over there. And typically recessions are headwinds for consumer discretionary things, but energy drinks often show remarkable resilience because people are just addicted to them. Talk to any developer team and you'll see them, killing themselves slowly with energy drinks like particularly Celsius. So let's have a look at the stock chart here. I did make a video on Celsius a couple of weeks back, and I said I absolutely love it. And I put on a thing here saying I'm going to buy it above 38.35, and did we close above 38.35? Story hasn't really changed here, to be honest with you. For me, it's a total buy, provided we exceed here the previous high, which is now moved up a little bit, by the way, which sits at about 39.22. Why am I saying you should pay more for it than you want right now? It's a counterintuitive thing, isn't it? But if you watch the masterclass, you'll understand. You see, stocks sort of do this sort of zigzaggedy thing, and at the moment, it looks pretty good. We have higher highs, we have higher lows, so that looks pretty good. The trend is kind of positive, but really what you want is you want to break out of that pattern, and you want to do that on great, big, beautiful volume. And at the moment, we're seeing very flat volume on this, so no one's really all that excited by it. So therefore, I would be always a little late to the party, and that way we know the party is good. You see, if you're the first one who shows up to a party, I used to go to Madrid a lot for the beautiful nightlife and beautiful, shan't go into the details, but you know what I'm talking about. I used to go to a nightclub at 1 a.m. And there was no one there. It's literally the only one there, me and a couple of friends. And we'd be like, this is weird. And you don't know if the club's any good. You don't know if the music's going to be any good. It just sucks. You come back at 4 and the party's going. And you know it's going to be great. Or you know it sucks, in which case you leave. It's very much the same with the stock market. That's an interesting analogy, isn't it? Nightlife in Madrid. You need to know that the beautiful girls are actually going to be there. If you just sit in an empty room, you don't know what sort of club you walked into. So that's pretty much the same here with that. But yeah, so I like it. I think could do with a little bit of a breakout that we haven't seen yet. If you want, yeah, that's kind of the way I would look at that. Now, what was the next stock here on the list? This is another one that gets a little bit more exciting. It is Robinhood. They're no longer just a trading platform. That's important. Why? Because a trading platform makes money out of fees. Now, they claim they have no fees, but they just sell your data and your trades to Citadel, who then make money out of them. Well, sorry, they don't make money out of them. They execute your trades in a most perfect manner for their bottom line. Sorry, not for their bottom line, for your bottom line. At least that's what they're saying. So that's the business model. And therefore, when you guys stop trading, they stop making money. So they're changing that. So they're expanding their business model pretty aggressively. So they acquired Trade PRM for about 300 million, which means they're going into wealth management. And that allows them to offer IRAs, robo-advisory platform services, and so on. They're expanding into Europe, into Asia. They're giving out gold-plated credit cards. And they're sort of becoming more like a traditional bank, a bit more of a trading platform mates with SoFi sort of type thing. And if we look at what the headmaster says about Robinhood, the headmaster says cash flow is a C, growth health is a B, price momentum is an A, which is, well, excellent. Also means the stock isn't that cheap. Profit health is a C, relative value is a D. Now, the market is clearly, without price momentum, confident in their expansion strategy. And their financials show some pretty good potential for future profitability. And I think they're executing well. I think, people like it. People don't understand it's a sheep in wolf's clothing or the other way around. You know what I'm saying? But that's okay. So what are you seeing when you look at the stock chart here? Well, you actually have a pretty rare pattern here, which I didn't actually realize was there. Let me delete some stuff here on the chart and highlight it for you. This, my friends, is an inverse head and shoulder. So it's like if I hang you upside down, then your head is down here, your left shoulder is here, your right shoulder is there. And what does that therefore mean? Well, it means that we get a very clear buy signal when we break through what I call the armpit line. So you have an armpit, here is armpit 1, yeah, and here is armpit 2, right? You're upside down and try to imagine it. And then when we break through that armpit line here, and we also broke through the 50-day moving average line, we get a lot more bullish on this thing. Now, for the more conservative-minded out there, and that certainly includes moi, I look at something a little bit more conservative, and I would look at the recent highs, which are sort of here, and I'd say we need to close above that. And we're kind of in that general space. So it's about 49 and a bit, call it $50, let's say. So above $50, I am bullisher than Citadel is on this little business venture of theirs. So for me, it's a good one. I like it. Yeah, earnings are coming up. Probably if you're watching this, you'll see whether it, commits suicide on that or no, or not. And that obviously might be something you want to wait out one extra day. But from a setup, from a chart setup, from a business setup, I like. Now, the next stock here, and again, we get a little bit more exciting. It is Palantir, which is where things get kind of, exciting. They just announced the general availability of their AIP agent studio from May 5th onwards. And I believe the market is underappreciating the importance of this once-in-a-generation type development. I should make a whole video on this, shouldn't I, and say, everything's just changed for Palantir, something silly like that. But what makes the platform here that we're talking about, AIP Agent Studio, genuinely revolutionary, is that it enables customers to build, deploy, and manage bespoke AI assistants, what they call AIP agents. And these agents leverage all the LLMs out there, so all the ChatGPTs and Claudes and all that stuff, with Palantir's core ontology, which is their structured enterprise data framework. Now, to put that into perspective, most companies today are using AI in a passive way. You ask a question, you get an answer. But what Palantir is enabling, it's agentic AI. Systems where systems that can plan, reason, and execute complex tasks autonomously to achieve business goals. And this represents the next frontier in enterprise AI. So the platform introduces a tiered framework guiding users from simple kind of analysis to way more increasingly complex automated agentic workflows, which makes basically running your business with a bunch of virtual employees possible. Now, what does the headmaster say on it? Well, the headmaster says cash flow gets an A, growth health an A, price momentum an A, profit health a B, and relative value an F. 3 A's is pretty remarkable. High gross margin, strong free cash flow, just insane. That this could grow and doesn't really cost them anything. Now, of course, the stock isn't super cheap, but it is one of those extraordinary businesses that I think most people just underestimate. I said yesterday, I thought it was a little extended, the rally here. I'm hoping that's going to pull back a little bit to the sort of the $100, $105 mark, and that I can nibble on that again there. But it might not. It might not. I mean, if you look at this, just the last candle that I have on the screen here, you see that there? We call that a hammer candle, and it's just the most bullish candle that you basically got, and it looks like that, right? To make it a little bit bigger. So it's got a very long shaft underneath it, a little bit of a thing up there. And what does it mean? It means you started the day here, right? You had a bit of a collapse, and you were at one point down here, and then somebody came in and bought the stock all the way back up to that very top there, which is where you closed at the end of the day. Pretty remarkable stuff. So very, very, very strong dip buying out there. So yeah, amazing setup here for Palantir, in my humble opinion. That doesn't mean you should go out and run out and buy it. You're going to come to your own conclusions, obviously. This is Winston's research. Now, next on my list, and I also talked about this stock priorly, which is that a word? KDP. We're really into sodas today, aren't we? I don't drink this stuff, but I'm making money out of it. Very impressive results for the last quarter. Very resilient in all this trading environment. So again, one of those stocks that just like took 2025 by the horns and said, we're going to go up. And their US refreshment beverages segment grew by 11%, which is pretty remarkable given everybody else out there is saying the US consumer is really miserable. Their core brands maintained strong momentum. They launched new flavors like, wait for it, Dr. Pepper Blackberry, Snapple Peach Tea and Lemonade, which resonates with consumers. And perhaps more interesting, there's a growing contribution from the majority stake in Ghost energy drinks. Another energy drink story here, right? Stark contrast with PepsiCo, but I said they set themselves up in Ireland for no apparent reason. So scorecard, well, cash flow is a C, growth is a C, price is a C, profit health is a C, relative value is a D. Very kind of a C sort of a stock. So it's one of those that helps you sleep at night. That's sort of the idea. It's a bit of a Coca-Cola rather than a Celcius, but it doesn't mean we can't make some nice returns on this. I mean, this thing was trading at $38 in September. Every reason we can go back there and beyond on strong performance. Right now, from a chart point of view, well, we are bouncing again and again, and by the looks of it, again, off this yellow 50-day moving average line there, which is important. And these bounces are not a bad thing, by the way. They're a good thing. They show us that there is resilience in here. So I like the bounces, but if you wanted to be a little bit more cautious, then you could also, of course, wait to take out the recent highs, which are sitting at about $36 and start nibbling above that. Again, you got to come to your own conclusions whether or not you want to buy stock for obvious reasons. There is another one. It's an energy stock, but it's not an energy drink. It is Duke Energy, completely different sector. It's sort of modernizing its infrastructure kind of type business. What do? Well, power plants. And their recent partnership with GE Vernova, also a stock I mentioned about a week ago, which gives them advanced US-made gas turbines, is very significant. It targets the enhanced capacity at their South Carolina facilities and aligns with broader trends in energy demand. Energy demand is going to go through the freaking roof. The founder of Google, testified in front of Congress just a day or so ago, and he said people are massively underestimating the energy needs required for AI. At the same time, the headmaster is reasonably happy with Dukes. He says cash flow is a C, growth is a C, price momentum is a C, profit health is a C, relative value is a D. Very similar to sort of KDP, one of those stocks, again, that makes you sleep well at night. It doesn't just make you sleep well at night, it makes you sleep in more comfort because you can now afford, luxury hotel bedding, that sort of thing. And let me just delete that here. So what do you see? Well, you see a really nice ziggity-zaggity upward pattern here. So if I connect just sort of the highs, that's kind of it. If I connect the lows, more or less, that's about it. And in between, you get this ziggity-zaggity pattern. And we like these patterns. We do. And when we're near the bottom of that pattern, it can be a pretty nice buy opportunity as long as we keep going in the right direction. And at the moment, it looks that way. Yesterday was another great big green candle closing at about $121. So I like it there. You could, if you wanted to be a little more cautious, wait for it to break out above the $125 up here. And again, obviously, you've got to come to your own conclusions. I'm not giving you financial advice for, but where we are right now is also the highs here of sort of last November. So kind of an important little resistance line there that we're gonna break through undoubtedly. And if you look at this, and you go, but hang on, the cash flow margin's not the same. There's a lot of debt there and stuff. It's an infrastructure companies. They're going to have to spend a lot of money on infrastructure investment. That's kind of how it works. They tend to carry a lot of debt. But that's okay because, well, it's an energy company. Now, let's jump to a different ship. This one here, ticker symbol SO, which is Southern Company, a utility. Exciting stuff, I know. And they've not only just announced their 24th consecutive dividend increase, which is now $2.96 per share. That isn't actually why I like the company. What caught my attention was a development from their subsidiary Southern Telecom. In April, they announced their largest fiber contract to date, 300-mile high-count fiber deployment, connecting major data centers in Montgomery, Birmingham, and Atlanta for hyperscale customers. And that's significant because it represents a non-utility growth driver that I believe the market hasn't fully appreciated yet. They are known primarily as a regulated utility, and regulated utilities are doing well right now. I'm nibbling on a few of them, but their ability to capitalize on the data center infrastructure demand could be another big, beautiful bonus. So if we look at the headmaster's card, cash flow score C, growth health, a B, price momentum, a C, profit health, a B, and relative value is a D. The B in growth is pretty exciting, and it reflects this emerging opportunity in their telecoms businesses. So you get consistent dividends and some AI growth thrown in. What's not to like? What about the stock? Well, it's also at a very nice start to the year. 2025 sort of kicked off around about here. We became rather nice and bullish on this thing and then sort of zigzagged our way down here. That was the only moment where the market obviously tanked on the tariff announcements, which doesn't really affect Southern all that much. And right now we are really close again to this 50-day moving average line here, but apparently gapping up. So this could be one of the last opportunities to get in on this thing below sort of $93 or thereabouts, which I guess is where the real buy level sits. Again, not a financial advice sort of type thing. It's just this is what I'm doing. This is what I'm looking at. Next stock is Leonardo. What do they do? Well, they're a provider of defense systems, electronics, and military support services. Now, you may not be as familiar with them compared to, say, Lockheed Martin, L3Harris, or Palantir, but that's precisely why this is an opportunity. They have very strong ties with the US military. They're working on a next-generation weapons control system for the Army's M109A7 Paladin. I don't know what that is, but it sounds like something big. They've also delivered advanced voice communication systems for Navy destroyers, and they recently achieved the milestone of delivering their 100,000th mission-critical combat system. So it must be fairly decent. And their focus on securing long-term contracts with the government gives them nice revenue predictability. The CEO warned of healthy adjusted EBITDA margin expansion. I don't like the word adjusted in there, but it looks like they're doing the right sort of thing. So what does the headmaster make of this? Well, cash flow is a B, growth health is a B, price momentum is an excellent A, profit health is a B, and other value is an F. The A in price momentum signals the market is onto this thing. We've got healthy profits. We expect forward PE to be lower than current PE, which is always a good thing. So it's one of those nice military contract sort of type recurring revenue kind of type businesses. And if you look at the chart here, well, it actually hasn't done anything since last November because we've had these highs here and we're at exactly that high. And that's precisely why I'm bringing it to your attention at this precise juncture in time. And it is, of course, the moment that we've all been waiting for. We want this to break through that line, which sits at, give or take, call it $38 to be safe, which is where all these highs sit. They're a touch lower than that. You can have a look at the stock chart exactly where it's sitting. But what I'm saying is we want to break through that. Actually, I'll give you the exact number. It's about 37.96. Call it 38. Yeah, 38 is where I want to buy this, and that would be the first time in 7 months that we've managed to break through this resistance. And once we do, provided we do it on some decent volume, then yippity-doo-dah, we shall hopefully go to the moon. So let's wrap this up. We've got 8 opportunities here, intentionally in different sectors, not always your usual ones. We've got Coca-Cola, we've got Southern, we've had Leonardo here, a bunch of other companies that we don't normally talk about all that much, Celcius, Robinhood, Dr. Pepper. And I think they're all solid businesses. I think they're all on the cusp of or in very, very good momentum, which is really what I care about here. Of course, you have to come to your own conclusion. You have to do your own research, just to have the confidence to know what you're doing. And if the stock goes in the wrong direction, you need to know why. You need to know where to set your stop to start with, because risk management is actually how we make all of our money. And if you want to go and learn that, which I very, very much I recommend you do, go to felixprehn.org/get-free and get free. That's the goal here. Get you retired, get you free, get you doing something meaningful with your life. So go to felixprehn.org/get-free, watch and learn for about 15 minutes. I know many of you have watched up 3, 4, 5, 6, even more times, which is amazing because it means there's a lot of value in there. And I wish you a tremendously successful year ahead. All the best.
And welcome to day 9 in Kitten World. So they've all tripled in weight now since they were born, which I think is a good sign. And you can start to see why, because this is what they get up to all the time, eating and sleeping, basically. Look at that. It's just one great big pile up of kittens. All 5 of them. All 5 of them. There we are. And we've got Tallulah sleeping here, guarding them. That's what she does. Little one.
The mega-cap tech stocks, meanwhile, they've been caught up in the recent market volatility, down around 19% since the president took office, but up today. All of this despite tech CEOs' efforts to court the president's favor.
In this video, I'm going to give you the complete analysis of these 2